Maybe as a start, like at this panel, we are just trying to discuss a little bit around the next wave of institutional Bitcoin yield, and maybe to start the conversation, let's you guys can feel free to introduce yourself and share what you're building, what your names are. You're pretty known in the industry, but for everybody who might not yet know. Maybe we start with you, Jacob.
Cool. Yeah, I can kick it off. Hey, everyone. Jacob Phillips, one of the co-founders of Lombard. Lombard is building a Bitcoin bridge that bridges BTC into DeFi ecosystems all across, I guess, any existing ecosystem, ETH mainnet, Solana, Sui, you name it. We sort of think of ourselves as a suite of middleware rather than us building like an independent base layer.
Hello? Yes. So I'm Diego Gutierrez. I'm the co-founder of Rootstock, the first Bitcoin layer, DeFi layer for Bitcoin, in production since 2018. So we are looking for Bitcoin DeFi, I would say, since 2015, when the idea started. And yeah, I think this is an evolutionary step. Maybe we were too early in a process, and now things are falling back into place. Also, awareness in the institutional sector, understanding of the value of Bitcoin as an asset has developed to a point where now we can address the institutional investors, and here we are discussing how and what's coming.
Hey everyone, Muneeb here. I'm the founder of Stacks, which is a Bitcoin L2, and plus one to Diego that I think we were there a little bit too early before the market was there, and I think we sort of like saw it coming. So Stacks started in 2017, mainnet went live in 2021, and I think we're really excited that the industry is actually finally catching up.
I've only been in this game for about a year, and it feels like forever. I can only imagine for you guys.
I think you start losing track of time. Now it looks like eternity.
No, I feel like both of us, like I think we were Bitcoiners first before we were building in Bitcoin. So it was kind of like great to see Bitcoin mature. Yeah. And I think we've always had like one leg in that community, and that kind of like keeps you grounded.
Awesome. Yeah. That's true. The industry moves quite fast. Maybe to start things, we're talking about institutional yield around Bitcoin. It would be great to understand what that means for you individually, and where you personally see the biggest opportunities on a high level. Maybe let's keep it in the beginning right now.
Yeah, maybe I can start it off. So Lombard started off as we built a liquid staking token, LBTC, the sort of first or largest Bitcoin liquid staking token built on Babylon. And when we were thinking about institutional yield when we first started this project, the whole impetus of this was that Babylon was going to be this massive catalyst for onboarding Bitcoin into DeFi. And the reason for this was that for the first time, you have like an attractive risk-reward profile for Bitcoin on chain through liquid staking tokens. So you think back to like last cycle, institutions were actually served really well with yield. They had like you had BlockFi and Celsius and all these different places you could lend your Bitcoin and earn a good yield. And then when all of those dried up, then you had Bitcoin L2s or like a new suite of Bitcoin L2s, I should say. Not like these new guys coming in, basically like liquidity mining to sort of create on-chain yield. And then Babylon popped up with Bitcoin staking, which became like the first sort of what felt like a little bit more organic, fully on-chain, non-custodial yield. And I think that now everything in the institutional Bitcoin space is sort of evolving. It's sort of evolving in two camps. Like one camp is us trying to produce native yield on-chain for Bitcoin through DeFi applications on chains like Rootstock and Stacks and ETH and Solana. And then another camp that's basically just trying to tokenize off-chain yield. And I hope, I think long-term, the fully on-chain yield ends up being the place where Bitcoin finds the most product market fit. In the meantime, there's so much scalable yield just by leveraging, off-chain yield in the form of, running the same basis strategies that are working in on centralized exchanges, and maybe even looking into the bar lend space, we'll see. But a lot of the most attractive yield opportunities just happen to be run off-chain in Bitcoin. Like nobody thinks of Athena as like a Bitcoin DeFi company, but they kind of are. So this is where our head's at least. We started with staking, now thinking about all different forms of yield.
Yeah, I think the main thing is like we are witnessing, with the Sailor strategy, we are witnessing a new wave of adoption on the corporate side. And you have a lot of companies following the model to a certain extent, maybe not becoming a full Bitcoin company, but having part of the treasury. So the following stage is like what to do with those Bitcoins, no? And I think, of course, offering yield is one thing, but that yield needs to come from sustainable sources. In a way, what we are all doing is like creating the environment to connect those sources of yield with those companies willing to increment their positions on Bitcoin. But on top of that, the following stage is like connecting that to short-term liquidity needs and using that treasury asset as collateral to get loans, which in my opinion, as long as they don't have counterparty risk and they started using the counterparty risk is replaced by platform risk, which is in a way the description of this model. It's like, what you will have is the best loan rates you can get anywhere. Because the asset is, of course, the loan to value ratios will be lower than that of real estate, for example. But in terms of execution of that loan, it will be instant. There's no default. So basically, you will have the best loans you can get from an asset. So if anything that you want to store value for the mid to long term will be moved into Bitcoin because of that reason, because it will be the best collateral to get short-term liquidity. On top of that, you want to build everything else, payments. So I think what we realize is like we need to start from this core engine of like storing value for the mid to long term, getting access to short-term liquidity, and then on top of that, build everything else that is needed in finance. Exchange of assets, FX markets, payments. So in a way, I think we are witnessing the beginning of the unlocking of the access to mass adoption for our industry because of this core engine. And we will start with corporations, but we will move into SMBs and finally into the whole population. It's a process.
Yeah, I think the Bitcoin treasury companies are super interesting because they're very different from the ETFs. The ETFs are sort of like, they're like, we'll see if it changes, but they don't plan to do much with the Bitcoin. Whereas these companies are very different. They have different bylaws, different sort of like management. And some of the ones like Pomp just announced today, and if you look at the announcements, like $750 million of new capital going into a Bitcoin treasury company. But if you look at the announcement, he's actively talking about using some of that capital, deploying it, and earning yields, and actually generating revenue using some of that capital, and not just buying Bitcoin and sitting on it. So I think some of these public companies are actually going to change the landscape a lot, and they're going to be looking for yields. And the first generation was, you have counterparty risk, and where we are right now is that we have platforms like Rootstock, Stacks, and others. Which do have their own sort of like security trade-offs, and a lot of the R&D work is directed towards how do we reduce that risk factor. So when someone actually mints their Bitcoin on a L2 or layer, whatever you want to call it, how much risk is there? Because that's going to determine how much capital is coming in. You can boost up the yields, right? Like people try doing that, but it's really the risk that's keeping a lot of institutions. And you mentioned Babylon, right? Like it got early initial traction. One of the biggest reasons was that the risk was perceived as very low because you were just locking on the L1 and your sort of slashing risk is pretty minimal. And I think you're going to see a lot more of that. So as that risk goes down, more Bitcoin is going to become available on these programmable networks. And obviously, DeFi risk is DeFi risk, and there are many layers of it. But at least at the base layer, and that's where we are focused, and I think we're doing a bunch of work there.
But I think there was mentioned by you, Jacob, for example, that a lot of yield opportunities right now are around Bitcoin are basically on CEXs, right? On the centralized exchanges. What roles do the custodian have in this whole thing? I mean, you just talked about basically you are building the infrastructure. I'm not sure if there are custodians involved, but I mean, you're having trade-offs on risk. Do you also have trade-offs on yield? And how do you plan to are you planning to beat yield that is being generated through custodians, through trading strategies? Or is that not even a thing? Maybe share some thoughts around that.
I mean, I'll give a quick answer that I think if you look at a more mature DeFi ecosystem like Ethereum, people can choose where they're getting the yields from in DeFi, right? And some of the smart contracts are now so heavily audited. If you look at like Alway, for example, right, hosting like, I don't know, $20 billion of capital in there, is like tried and tested. This is not the case in Bitcoin DeFi now, right? So if you hold ETH, you actually have more opportunities in a way. You can either go to DeFi or you can go to the centralized exchanges and try to run different games there. Bitcoin is actually lagging in that. So short-term opportunities is to try and bring the maturity of DeFi and the infrastructure to a level where the decentralized yield side actually becomes more of an option. And I think for the coming years, that's where at least we are focused.
Yeah, I mean, that definitely hits home. Like, if you think about right now, I like the way that Muneeb framed the yield conversation of, like, the goal is not actually maximization of yield, it's minimization of risk. And right now, maybe up until the Bybit hack, it was pretty clear that, like, minimization of risk was using centralized exchanges or using battle-tested custodians as, like, the base root of security. If you think about DeFi, like last summer, or last cycle rather, in 2020, when all the protocols were just sort of getting up off the ground, it was very clear that the amount of yield needed to be paid just to compensate the amount of smart contract risk you were taking on was quite significant, to the point where it was prohibitively expensive for institutions to participate. And now over time, like every year that Aave doesn't get hacked, it kind of like ticks down lower and lower. And now, I mean, you think about the real goal here for all of DeFi, I think, is to think about the biggest money, and the biggest money doesn't need that much yield. They just need to make sure that they're not going to be swiped by smart contract risk or counterparty risk. So I think still give Bitcoin DeFi a couple years, and I think this will all fall into place, provided we stay true to the security standards that we put forth. And so I think it's only a matter of time. And I mean, Lombard's only been around for a year, and I think we've been impressed by the take-up of people on the institutional side. Institutions kind of only care about Bitcoin and stablecoins, and so to the extent we can continue to put out solutions that work for their sort of security preferences, if they want to use battle-tested custodians that they see as risk preferential on their end, then I think the best thing we can do in the short term is let them do that and use that as a bridge to longer-term, fully decentralized solutions.
I think there's two things. One thing that Jacob mentioned around the thing about platforms, the longest they run, the more money they have at stake, the harder they get. So it's like, that is, in a way, is kind of the opposing to counterparty risk. So platform risk, if the platform keeps running for a long time with more and more money at stake, it's almost impossible to get hacked, because if it wasn't hacked, it's not because they didn't try. No, it's like in open systems, all the time you are being attacked. While counterparty risk, it's a little bit of the other way around. It's like the more money a custodian has, is like the more safeguards you have to put, like more oversight, more stronger insurance, a lot of things that turns into cost. That's why we are saying it's like the way is to replace like counterparty risk for platform risk. But I think we will have a hybrid model, because real yield, for example, now exists. There is real yield, for example, for Bitcoin on L1 for short-term lending for institutions that operate in Bitcoin, ETFs and so things like that. But they are not willing yet to go to a layer 2, for example. So how we bridge those risks and how we create the as Muneeb was saying, the safety environment where they feel confident to move and operate in a network where everything can be fully automated, and you don't have like one part, the custody on chain, and another part that is the management of the asset somewhere else. So I think we are in that process, and I think we will have hybrid models for a few years now until that trust on the platforms is made. In Rootstock, we have a protocol regarding on-chain yield, that is money on-chain, that has been running for 5 years, 6 years now. And they have been creating like 4% yield in Bitcoin organically on chain. But the problem is like it has a lot of variables. You don't have assurance, and how to manage the getting in and out of the protocol is complex. So I see people like taking that protocol and creating maybe a liquidity buffer on top of that to create a product that is easier to understand or to engage for people. So I think we have some early experiences on on-chain yield generation, but they are not packaged in a way that is appealing for an institutional investor that wants to say, okay, I want to put my Bitcoin here and get this fixed percentage of yield every year. So we are in that process of finding out. Mm-hmm.
Okay, so basically what we have established, correct me if I'm wrong, so like yield is not the most important thing for institutional investors, but it's security, right? They want to have their assets secure. Maybe from your individuals' experiences, like how are you then convincing these institutional investors that your protocols are secure, like so that they are comfortable, basically providing liquidity or using the yield opportunities on top of Lombard stakes, or let's say DeFi opportunities on Rootstock?
Yeah, maybe I can start with this. When we were starting Lombard, the first thing we did was went to the smartest key management custody people we knew in the industry, which was these folks over at Cubis, Carnegie Mellon professors, built and sold a Web2 cybersecurity company to VMware. And they built out our initial, our whole initial security model, collaborated with us directly on the sort of key management software that then became the Lombard Consortium. And all of this comes back to, I mean, the only sort of pitch that works realistically is like, we have to take whatever battle-tested infrastructure there is in the centralized ecosystem and port it over into a decentralized environment. So any good security system has the principles of layered security, where you have 4 different layers. You assume each of them fail independently, and the system still needs to maintain safe. So all of this, I guess I should say, these theoretical arguments get some version of investors on board, and it's all about like for the most secure, for the largest institutions, the only way you're going to be able to get those people on board is, time will tell effectively. I guess no theoretical security arguments are going to work until you see a system battle tested in practice. So maybe one thing Lombard did pretty well, I think, relative to other folks that were competing in the space, where we sort of targeted the right pockets of capital at the right point in time. So, and I was going to make this point actually around the discussion of yield versus security. Growth in crypto is path dependent. So, for example, if Hyperliquid went out and decided to market themselves as an institutional grade exchange, had they started with the initial tech stack and called themselves institutional, versus had they hacked something together really quickly that had great UX, bootstrapped all of this retail adoption, and then now call themselves the institutional exchange. I think the two are very, very different. And so the same is true for any project. Aave didn't necessarily start off as like the most secure. I mean, Compound for a while was the secure bar lend protocol, but then Aave, through bootstrapping usage, then sort of took that crown, and now their full focus is security. So I think it's the same way in the Bitcoin space, where it's like, we needed to start with some sufficiently decentralized or sufficiently secure solution to get people on board. And over time, I think that, as you reach different pockets of capital, you sort of have to update your security requirements for each of those folks. And yeah, I mean, I think the biggest thing for us has just been, really quickly, we had hundreds of $1 million on board that then act as a bit of a sticking point for people when they were evaluating the system. You sort of look at empirical evidence much more rigorously than theoretical.
In our case, I think the underlying attributes of the platform, I mean, Rootstock has 2 components. One is the network itself that is secured by the Bitcoin miners. So recently, Rootstock reached 87% of the hashing power of Bitcoin. So by doing so, it's the second safest network after Bitcoin. So that's one thing once you are in Rootstock. The other thing is the bridge between Bitcoin and Rootstock that has been, as I said, the longest running bridge. It started in January 2018, so it's more than 7 years running. It holds around 3,000 Bitcoin, never had a hack, so 7 years running with 3,000 Bitcoins at stake. That is like, the combination of those two is like pretty good security. But as Muneeb said, on top of that, you have the DeFi protocol security, the smart contract security. So depending on the protocol maturity. If you talk about money on chain, 6 years running, $100 million in TVL, so that's pretty safe. But if it's a new protocol, what we do is we do baby steps. We put our money first, and then we work with the institutional investors also through that process. So because we acknowledge, we did the same with the peg with Bitcoin. Is at the beginning it was capped, not because the technology, we were not secure on the technology, but we wanted to make sure that it has a proper hardening over the years, and we apply the same principles for everything we offer to institutional investors, and we also work with partners on the other part. One thing we didn't mention, like the administrative, legal, jurisdictional things, because we usually work with a partner that will, because we didn't talk about that, but it's not only about the protocols, the handling of the assets or the yield generation on chain, but also how you interface with institutions on their language, on their jurisdiction. No? So that's the other thing. We are building a network of partners to offer these products and this offering to different regions. But one thing we didn't discuss is UX, and I think that's where we are lagging a lot. It's like the user experience is not yet, I think, on the level. So for now, we are like trying to if you want to fill the holes ourselves, like doing like a white glove kind of service with that, working with partners and everything. But I think in crypto in general, the UX still needs to develop a lot to get to a point where it's mainstream.
Just like you're after, but just to summarize, so you're basing it super important to have like a track record, or like to have your product or your opportunities or your contracts battle tested over time, and you cannot battle test with institutional BTC probably as easily. So you're like starting with retail, and then you're just trying to penetrate like another sector. What comes after retail? Maybe higher net worth individuals, like bigger whales, and then you're kind of building the trust, I guess, to then also be attractive or basically get some attention by bigger institutionals, whilst also changing up security mechanisms along the way to also, be more,
Exactly, that's spot on. I think you said it better than I did.
Okay, yeah. Maybe then, like after this summary, like Muneeb, what has been like Stacks' approach? Is it similar, or like do you have any thoughts around this?
No, I was just going to plus one. I think the same thing. We started with 1,000 BTC cap, then went to 3,000. Now we're capped at 5,000. And we're doing the same thing, incremental security upgrades to our system and designs on the roadmap. And I think that's the playbook.
Yeah, with complex systems, the thing that you don't know is like once you have Turing completeness or general purpose programming, basically the surface of attack is unknown. With very little, I mean, once you pass a certain amount of lines of code, you have an unknown surface of attack. That's why there's no, unless there is formal verification, there is like, in the case of Bitcoin, the scripting language is a push-down automata, which basically doesn't have logical forking or iteration. So that's why, it's because then you have a known surface of attack. But in the case of the environments we are creating that wants to have more complex primitives, financial primitives, you need to have general purpose programming. You need to have like, so at the end, the hardening process is unavoidable. So it's time and money at stake. That's it. Like,
okay, very interesting. So basically the institutional game is kind of also a retail game in the beginning. Maybe like, because we only have a few minutes left, in 3 to 5 years, what's one breakthrough in Bitcoin yield that could transform institutional investments, and how is your project positioned for that?
I think the obvious one is that, in 3 to 5 years, Bitcoin will have fully trustless bridging through BitVM or Opcat or some similar solution. But the other one that's on our mind quite a bit is, going back to the UX side that Diego was mentioning, or the sort of retail bootstrapping path that I was discussing that Hyperliquid took. One of the things that, we've sort of realized is there really exists a lack of Bitcoin yield on chain. I think the second that we start to have DeFi protocols built entirely on Bitcoin, or like using Bitcoin as the predominant collateral, as the way that all centralized exchanges are built, you'll start to see much more of that Bitcoin come on chain and then stay on chain. tokenizing off-chain yield is a good way to sort of like bring people on-chain in the first place, or like staking was a great catalyst to get people starting to slosh Bitcoin around. But in order for people to stay, we need to, Bitcoin needs to be treated as the collateral. So Hyperliquid actually did a really great job of this. They sort of spun up a 2 of 3 multi-sig, like a very simple bridge, and quickly onboarded, I think, $100 million of Bitcoin. And now they do like $50 million of BTC spot trading volume. And when you go to the Hyperliquid page, they brand it as native Bitcoin. That to me was like, when people ask me what the like best Bitcoin DeFi protocol is, I usually tell them Hyperliquid, kind of jokingly, because it really is like the best UX for using your Bitcoin in a decentralized system. It feels like a centralized exchange. So the second you can start doing that in any ecosystem, ETH, Solana, Sui, wherever builders are, they have the ability to build these like very Bitcoin native experiences, rather than right now building with like 4 different primitives, all with their different lettering. I think that confuses the hell out of people. And so the second we get back to people just thinking of like, hey, I'm a builder, I'm creating a fintech app, I'm creating with a centralized exchange, I'm creating with Robinhood, I need to create the best UX, then we'll start to get people to actually start using their Bitcoin on chain. And then they won't have to go do something with it afterwards. They don't. If people are just bringing their Bitcoin on chain to earn a little bit of yield and they're going right back to the centralized exchange after, I don't think that's really what we've set out here to build. So the second you start to get this like DeFi native form of Bitcoin yield, I think things will really kick off.
I think the primitive what I think that is the killer app of this is pretty simple. Is using Bitcoin as a store of value for the mid to long term, and then you choose if you want to get yield. And I agree, eventually we'll get to on-chain yield more and more. But that's a process. Again, I think we will be hybrid for a few years now. And then against that store of value asset, you can get loans at the best rate possible. And then if those loans very likely will be in stable coins, and then you connect that to the payment systems of the world, then you have the core financial engine of any human being and institution, and that's what we will see built. Then you have everything else. No, then you have perps, you have options, futures, whatever. No, like the more complex financial tools. But I think next year's will be about like putting in place this core engine around Bitcoin, and then deploying these into individuals, institutions, SMEs, like across the world. So
I think we heard that with BitVM2 or some of the work that we are doing at Stacks, we'll figure out the how to move your BTC from L1 to L2. Right now, a risk is there because of bridging. I think the next challenge that we'll likely need to solve in the next 3 to 5 years is going to be, even if you can mint on an L2 without bridging risk, you still have DeFi risk. And I think that's going to require some fundamental retooling of how smart contracts are written. You mentioned programming languages. Like we have done some work on decidable languages, or even using some Bitcoin tooling to see where the underlying Bitcoin actually sits. And it can only leave under certain conditions, and basically trying to reduce that attack surface of what can happen once the Bitcoin actually moves into DeFi. So I think that's probably one of the biggest R&D areas in the coming years.
Yeah, I think BitVMX is the flavor we are working on. It's a breakthrough because it reduces. Until now, the bridging with Bitcoin was a multi-sig where you had, half plus one of the members need to stay honest, and basically with BitVMX, as long as one of the pegnatories or the signatories of that stays honest, you have safety. So that's a big breakthrough. Also, if you combine that with super federations where you can have tens of pegnatories, and as long as one is it. So I think that problem is kind of sorted out. Like with anything in deep tech, it's not that we have the first prototypes. Union Bridge will go in production this year. That is the bridge we are building with BitVMX. But to be honest, again, it's like it takes like multiple years until that can replace the current peg. So regardless of the hype around it, it's like if you're realistic, when you have been building deep tech and like we did for many years, that you launch it with again 100 bitcoins, then cap, then with 500 bitcoins cap, then 1,000. So it's like maybe a couple of years until that technology will mature. So it's not something that will revolutionize. So the focus, in my opinion, is where Muneeb was saying, is like we need to harden the other part while this part gets hardened. We need to create the proper UX. We need to sort also the regulatory needs, because, I mean, even if it's fully on chain, the institutions reside somewhere, so you need to comply. That's why I was saying we need to build an ecosystem around this of people who will package these solutions, regardless they are running on platforms, and tailor it to the needs of the different institutions, individuals, businesses that will use these solutions.
Okay. Great. Maybe like if you guys have a little bit more time, I can also give the audience the opportunity to ask some questions, or even you guys, if you want to ask one more question beyond each other. You have the opportunity now for a few more seconds.
I think everything was so clear, no
Okay.
questions.
Yeah. I mean, then, it was very great having you here today, and happy to continue the conversation outside.
Yeah, it was my first time sitting behind a bar doing this.
Yeah, we are. You're not the only.
It's mine too. I didn't realize it. That's good. So we can, serve some beers now.
All right, perfect. Thanks, everyone.